Hey guys, good afternoon. Like I told you, I'd take my happy medicine, and I've done that. I'm feeling pretty good right now, liking what's happening before the Fed rate cut decision. Tesla up 1.11%, PayPal up 1.56%, Hood up 1.26%, markets flat on the day, SoFi up a 0.5%, and Bitcoin's still hovering around 60K, man. I don't think there's anything you can hate really about what's going on right now. Again, that decision comes real quick. Let's see. Is there any other economic data? Not really. Just stockpiles of different fuels and crude and all kinds of crap. 17 bill auction doesn't really matter. So again, the Fed rate decision comes in 19 minutes. That's the big deal. And we'll probably go over a few topics in the meantime. Let me just get caught up with chat though while I'm here. Andy Zhao said 50 BIP cut. Here we go. I think that's what's going to happen. We're at 25 BIP cut, and we turn red because the price. Yeah, no, I agree. I actually agree. I think it would need to be 50. It would be ineffective otherwise. Kenny Brown presenting the Super Bowl of markets and economic policy. What's up, bro? And Needs, thank you for your kind words. Very much appreciate it. David, Jesse is like a teacher. Thanks a lot, Jesse, the King David father. That's why your parents called you Jesse. Thanks, man. Even if Powell is tough, the market down, we good. I don't think it's not going to matter. In the end, we're still going up. And again, Tom Lee said that we could have a reactionary period of like a week or week and a half where we go down. That's possible too. I mean, the market, I don't know. I'm not seeing it in the price action, but it's possible. Anything's possible. We always have to remember that. David, thank you for the membership. I appreciate you. Let's see. Christopher Brown said Gergevin predicted a 25 bip cut for whatever that's worth. It's not usually worth much, but I do like that guy. Stefan, yo, Jesse, let's fucking go. And I didn't mean your comment, Christopher. I meant coming from Gergevin. Edward, we ready? Yes. Silas, hello. What's up, buddy? Edward Rivera, you're the man from LA. Might be in prison after retweeting a parody. It's funny until it's not. That's right. It's funny until it's not. It's kind of a frightening fucking thing to think of. So I hope that never happens.
Points versus a half point.
One second. I'm just going to turn this on.
Elizabeth Warren.
I'm going to play this. Oh my God, they got Elizabeth Warren on. I love her. She's so great. Anyway, Silas calls for a 38 basis point cut. Yep. I was actually thinking 36 and a half. But that might work too. This is sarcasm, guys. Chris Federal, lets the doves fly. I agree. Disease Kodak, sub Jesse and the gang. Michael Krause, that's my boy. Hello, everyone. Are you having a profitable day? I think I am. I haven't even looked, honestly. I'm too caught up in political bullshit. Hey, let's listen to this bitch. 1 second.
That deep in cutting right now. Make the case.
So let's start with Jay Powell. He's already made the case. He said he waited too long. And the best way you can show that you waited too long and that you get it and that you are becoming more responsive to where we are on interest rates is actually go ahead and do a nice big rate cut. Keep in mind that keeping those rates high, as he has done, keeping those interest rates so high, actually has contributed to our measure of inflation. So it means for all those housing developers out there, we need more housing, right? They say, I can't afford to do this because the interest rates are simply too high. Borrowing costs are so high. It means we have fewer new apartments coming online. It means fewer new houses coming online. And it means...
Guys, Elizabeth Warren, one of the worst economists ever invented. She's amazing.
For families who want to buy, the cost is higher. And talk about a loop that feeds back into the measure of inflation and keeps that number high. Look, overall... We know we've headed in the right direction. Inflation is right now around 2.5.
Yeah, let's pull it. I gotta take a break from her voice anyways. She makes me sick every time I listen to her. How much we cutting? 0, 25, 50, 75. Elizabeth Warren. All right, there we go. Poll started, guys. Have at it. Back to this lady.
6.5%. That's down from about 7% 2 years ago. So it's a third of what it was. And yet the Fed hasn't budged. It's time for them to budge and to show that they remember that they have a two-part.
Yeah, we need to juice the economy right before the election because we're faking the polls as good as we can with Kamala Harris, but we're afraid that people still might realize that she's not winning.
Mandate. It's not just inflation, it's also about jobs, the economy, as families feel it on the ground. The best way to signal that is go with a big rate cut.
One point that many viewers wanted me to ask you about is if we're criticizing the presidential candidates
so
for sort of wanting more influence over the Fed. I'm talking about Trump in particular here. Is it appropriate for senators to be writing a letter expressing a viewpoint that is putting pressure on the Fed to do something that is seen as overly political because it comes from one party? What is the difference there? Just explain why that is appropriate, but not from the president.
I will make 2 points here. The first is that we are making an economic argument here. And you and I have talked many times about this. It's a consistent economic argument, reminding the Fed of their legal obligation to follow two parts, right? They have a two-part mandate here. And that's part of my job in oversight as a senator. That's what I'm supposed to do. I also want to be clear, I'm doing this right out in public. Everybody can see it. You can see exactly when it happens. That is very different from someone saying, I want to be able to squeeze behind.
Sorry, I got to pause this bitch again. I am actually streaming on Rumble, guys. I'm streaming on Rumble. Look at this. I got to show you. It's actually working. Inception time. Inception time. Just go watch it dial down the line. No, I'm kidding. But I'm excited. I got it working. That's cool. Anyway, diversification, baby. That's what I do. All right. Let's get back to it. Let's listen to the crazy lady. And the odds, just so you guys know, Fed Watch Tool has us at 61% still for a 50, which is pretty high. So not much change there with the data that we had today. So I think it's pretty likely. Let's just check out some of these other things too. I can only hear so much of her voice. I got to take it in increments, guys. I've already got a headache. 57 greed for the stock market. Rumble, I'm far right. I've decided to go full right. I think that's the way to do it. You know, if you're going to commit to something, fucking do it. That's what I say. All right. Let's see here. Still nothing over here, so let's get back to our Warren. Let's see what she has to say, guys.
Closed doors, and I want to be able to do it for political reasons. I think those two are very different. But understand, I ain't saying anything in private that I'm not saying right out there in public for everybody to evaluate.
Let's turn to the economy more broadly.
All right.
Senator Kennedy.
I'm like, let it all.
Sorry, I just didn't want to hear like that 15 minutes. We'll see if there's anything here.
Happen.
You mean I tell you what, you want industries where there is exactly one giant at the top and you think prices are going to come down? Not going to happen.
There. Senator Elizabeth Warren of Massachusetts, thank you very much. Appreciate it.
And as I mentioned, coming up.
Oh, she's the worst. We got past her, guys.
Longtime Fed watcher.
I'm just going to mute this. There's nothing going on here. Let me see what else is happening in markets. I'll get caught up with chat too and make sure I haven't missed anything. Let's see how our poll's doing. What do we got now? How many we got here? We got 56% say 25. Are you really? All right. I wouldn't have guessed that. These polls are pretty handy. I wouldn't have guessed people thought that way. Interesting. Vomit in my mouth, says Ryan. Yeah, dude. It's like, oh, every time. She's just so stupid. That you know what I can't handle? And you guys have probably experienced many people like this, I imagine, in your life. But I've probably been one of these people on the other side of some argument many times in my life. But people that are really stupid about a topic, and yet they're very arrogant and think they know it all. And then the worst part is when they can convince other people because of their confidence in their own stupidity. It's the worst. It's like, no, that's not how any of this, nope. Oh, well, I'm sorry, they're confident, so we should do it that way. Okay. Oh, yeah, no, makes sense. Makes sense. So I always hated that in business, and that's who she is. She's very much that person. She's very, very confident about her stupidity, and it's very annoying. I can't handle it. Can't handle those kind of people. If you're going to be a smart ass, be smart. Understand what you're talking about. The most ignorant people think they're the smartest I know. It's true. And I kind of feel that way about myself, so it makes me go like, you know, I don't know. All right, how many votes we got? 135. I feel like that's good enough. We're going to end the poll and see how it goes. Boop, boop, boop. Output. So it looks like we got 57% for 25. That's actually shocking to me. I would have thought that you guys were on the 50 bip train, but Hey, if we get 50 bips, you guys will be happy. So that's good to hear. Good to hear. I can't believe I'm streaming on 3 platforms. I'm such a big boy. Get my little Discord up. It's going to be so cool. All right, let's see what else we got here. We might as well, while we're waiting on this stupid stuff, we can jump over and see what else we might want to talk about. There was some Tesla stuff that was kind of good today, and Bitcoin-related news too. Again, I talked about it earlier, some of the other chats, but BlackRock had a really good report. It was awesome. So let me see if I can find that real quick. Hit the like button, guys. John Mahoney says. I don't disagree with him. So if you guys want to do that, that'd be cool. That'd be cool. Actually, let me see. Might have a few other things. Let me just look through bookmarks here. The BlackRock Microsoft thing. So there's $100 billion that they're looking to incorporate into AI data centers. I always worry when Microsoft and BlackRock are working together. That's just a me thing. Bitcoin. So yeah, there's a couple of cool things I want to show you while we're waiting here. We got about 9 minutes until Papa Powell makes a decision, or at least reports what the decision is. And there's a lot of stuff about Bitcoin. So look at this bull flag. Stock Money Lizard was just showing a typical bull flag pattern, showing what the measured move should roughly get us. I actually agree with him on the measured move. I think it's probably 92, but some people think 102. It's going to land somewhere in there. I'm just more conservative, I think, the most, which sounds weird because I take huge bets. But Bitcoin news, BlackRock's latest report on Bitcoin includes a striking comparison table highlighting how Bitcoin, the S&P 500, and gold performed after major geopolitical events. I think this is actually kind of a big deal. This is an interesting thing to look at. So we're going back to 2020, the U.S.-Iran escalation. Bitcoin over the 10 days had the best return. And then it had over 60 days, it had the best return by far when compared to the S&P and gold. In fact, over 60 days, you can see the S&P after the U.S.-Iran escalation was -7. Gold was up 6, and Bitcoin was 20. So that's a pretty good return. COVID was interesting. COVID smashed liquidity from everything as it pulled in U.S. dollars. So all of them did bad, and Bitcoin did the worst for the first 10 days. But if you go out 60 days, it had by far the best return out of all of them. The 2020 U.S. election changes had Bitcoin by far outperforming all of the rest of them over the 10-day time frame, and substantially, yet again, 131% return over a 60-day time frame. Fascinating. That's happening now, guys. Don't you think you want that 131%? Russia invasion of Ukraine, Bitcoin did the worst. But over a 60-day time frame, did the best by a multiplier of more than 2x just from gold, and then 5x from the S&P. The U.S. regional banking crisis, Bitcoin did the best, up 25%, substantially better than the other two over 10 days, and then up 32% over 60. The yen carry trade unwinding, we haven't hit our 60 mark yet. I don't think. No, I don't think so. So maybe they don't have those calculated. I could probably figure those out. But I'm willing to bet it follows the trend of the other five fucking times that Bitcoin proved that it is the best fucking asset on the planet. Anyway, yeah, I am having a good day, Anthony. Thank you for asking. All right, done with that tirade. But maybe you should own Bitcoin. I don't know how many other fucking ways to say it. Hopefully I'm getting through to you guys in some way. Willy Woo. Well, it's math. I mean, it's math. If you can't figure it out at this point, there's not much hope for you. Maybe you'll do it when everybody else does it. Willy Woo, he's a cool guy. Sometimes. He's kind of a communist, too. Yeah, he lives in Hong Kong, I think, still. But he's outside of that, he's all right. And everybody's got their views of their own government, right? Like, whatever. He said Bitcoin signals short-term continuation of bullish swing, likely 1 week left to play. Mid-term or medium term, we're seeing lots of spot BTC being scooped up. Spot just means at the exchanges. That's it. Like, that's the simple term. Exchange inventory accounting for derivatives remains flat. I don't even want to get into derivatives. It's just like paper versions of everything else and heavily levered. Let's just put it that way. But this could change quickly if we get a short squeeze. Chart pattern is forming a bull flag. I agree. I think a few people agree with that. And we're getting ready to break higher. And so he's just showing the fact that we could be seeing a short squeeze and we could have bullish momentum to the upside. It's just kind of his more complicated way of saying it. But let's just scroll down here. MicroStrategy. So they bought a 1.2 billion a couple of weeks ago, and then they're like, you know what we need to do? We need to raise 700 million in a convertible note in order to be able to get more Bitcoin. But then they're like, you know what? 700 million, just not enough money. Let's do 875 million in outstanding notes now for Bitcoin. So they're over allocating again. It'll just make the price of everything go up because that's what MicroStrategy does. They make a ton of money. Hodl 15 Capital said BlackRock published a great Bitcoin report. This is the full report. If you guys haven't seen this, I real quickly here will untweet this and retweet it so that it will be at the top of the list. I highly encourage you to read it. I showed you one image from it showing you that it's by far the best risk-related asset on the fucking planet. And so the rest of the report's pretty good too. You might want to spend a second and actually read it and maybe try and understand it. And if you have questions about it, I'm happy to answer those. That's why I'm here. Let's sift through some stuff. I don't know if I want to pull up my trading view because when I do that, it collapses everything else. But again, market's still looking good. Still looking solid. I think I actually, oh crap, do I have that? I was going to say I'd like to put the ticker on here too. I think I will do that. Give me 1 second, guys. I'm going to put the stock ticker on here. If I could figure out where it is. Where is it? It's over here. Okay. I need to put the... 1 second here. I gotta find this fucking thing. I don't even know. I got some weird thing going on with this ticker. Let me see if I can reset it. Talk amongst yourselves in chat for a second, guys. Throw out questions, anything you got. I'm gonna try and I'm gonna open this up. I'm just gonna go ahead and pull up something real quick. I'm gonna pull up Bitcoin. I do want to have the stock ticker. It might actually temporarily override our chat. I might throw it somewhere else on the screen. Or I should say this. I want the Bitcoin ticker, and then I might change it to other things along the way. Because I do want to see how Bitcoin does during this conversation with the Fed. So I'm gonna put it on the hourly, tighten some stuff up, and make sure that we're looking at that because I think it could be very, very enlightening to see how Bitcoin performs over whatever time. So we're going to put it there on the hour, and then I'm going to pull this down to my other screen. Let's see, where can I put it? Maybe over here. Shrink this up. 1 second, guys. I got to kind of shrink it to get my other chat to work. Okay, cool. And then now I got to add it to my screen. This is fun. I'm just talking through it along the way. How entertaining is this, guys? Hype in the chat, guys. Hype in the chat for your opportunity to be able to watch me click on shit. That ain't it. Oh, let me see here. Where are you? Where are you? OBS. Nope. Xmedia. Nope. YouTube Studio. No. No. All right, 1 second. I got to see if I can find this fucking thing. I don't know why. Sometimes stuff is weird in OBS. And I might just use another example here. There we go. So let me see. This should theoretically work. It's not on the screen. 1 second. Okay. I don't know what just happened there. Is that flipped? What the fuck? Aha. Okay. So let me do this. I'm going to maybe reset this transform. There we go. All right, let me do this. I got to figure out, I got to make this like opaque or something. I'll try and push this down in the corner. All right, whatever. We'll just keep it over there. Hopefully it won't take too much. I can always enlarge it along the way. I just want to make sure we got a good view. 1 second. Let's see this. Maybe I will keep it on. No, I want to get in a little closer. 1 sec here. Sorry, guys. I know this is boring as shit. We're waiting right now anyway. We have... Oh, we're about to start. Actually, let me hop in here so I don't get too distracted. Actually, let me go here. We'll go into this one. Refresh. Oh, this is his actual Fed rate. I need to get into this screen. What am I thinking? All right, so we're waiting on this. We've got 30 seconds right now. 30 seconds. And I'm going to try and refresh this, make it a little bit larger. Oh, it's generating, guys. It's on the screen. What's it gonna do? What's it gonna do? We going up or we going down? All right, let's see what happens here. If you guys find it before I do, let me know. All right, the big event here in a little bit is going to be this. The big event, guys, is just If you guys find out before I do, sometimes the screen doesn't refresh because it gets too much traffic. Bitcoin's dropping. Bitcoin's pumping. Bitcoin's pumping. Oh, shit, it is. Did we get a decision? If you guys see a number before I do, let me know. Bitcoin's going up. Bitcoin's going up. Keep going. Keep going, bitch. Interest rate projections, 2.9%. 50. We got a 50. Sweet. Beautiful. Okay, let me read. This thing got weird. Let me get over there to save it again. Beautiful, guys. 50. Loving it. Why isn't this populating? I think their site is getting overrun. It's just like clocking. Beautiful, guys. We got 50 bips. As you can see, Bitcoin is jumping. We're pushing closer to 61,000 right now. This is what was going to happen. I'm also going to, let me do this real quick too. I'm going to see if I can get some of these stupid windows off my screen. 1 second. I want to see, I'm on this. So now if I go here, I should be able to get a heat map. Ah, cool. Okay. So let me do this. I'm going to get this heat map on percent per an hour. Yeah, I think that's right. So we're seeing, this is what we're seeing since the report came out, roughly. Some of this might be a little bit before. I don't think I can go lower than an hour. Let me see here. No, I can't. So, but yeah, so we're doing all right, guys. Bitcoin is doing all right. Hitting 61,000 right now. I love it. This is exciting. So we've got 28 minutes until Papa Powell speaks. Let's see what we got for commentary right now from these guys. 1 second here. I'm just going to refresh and make sure I've got live commentary, and then we'll start listening.
On the economic description, the economies continue to...
1 sec. I want to go back. I want to hear what he has to say.
Very short time, but we are just...
Here we go.
Dissent, Fed Governor Michelle Bowman preferring to cut by 25, but 11 voting in favor of 50. It might have been close. I'll come back to that at the end of this report. The statement says the committee will consider additional adjustments to policy based on the data, the outlook, and the balance of risks. The summary of economic projections saying an additional 50 is expected or forecast by the median Fed member for this year, for a total of 100 this year. That would bring the median...
Hey guys, I just wanted to clarify. Gergevin was fucking wrong. I was right again. And you guys were wrong, as the poll recently said. I was right. I just want to, I feel bad saying that, but it's true. So, whatever.
Down to 4.4%, or an additional 50 basis points from where we are right now. Another 100 basis points of cuts expected through next year, bringing the rate down to 3.4%. All of that a bit above where the market is priced.
That would be better.
And the new long-run rate would hit 2.9%. That's up a tick
Stephen
by the year
right.
2026. The statement now says the Fed is firmly
right.
committed to supporting both maximum employment and the 2% inflation target. Before and for many months before this, the Fed had relied solely on saying it was focused on the inflation target. The committee has gained greater confidence, the statement said, that inflation is moving to that 2% target.
Hey guys, real quick, can you hit the like button? There's 475 people here, and it would be really beneficial for my channel if you would do that.
Progress towards 2%, but remains elevated. It's seen declining to 2.3% this year, 2.1% next year, and hitting the target 2% by 2026. Unemployment, the outlook for unemployment did tick up. I think that's important to what the Fed said here and what it did. Up 0.4 to 4.4%, 2 ticks higher than it is right now. Growth pegged at 2%, slightly above the 1.8 potential, well into 2027. Now, 9 officials in the dot plot wanted to do 75 basis points or less this year, and 10 wanted to do 100 or more. So it may have been a very close call as to what was actually wanted around the table in terms of 25 or 50 today, but they decided ultimately with 11 voting in favor of the 50 basis point rate cut. Tyler.
All right, Steve, stick around as we get back to our panel for some reaction. Claudia, you were the one who said 50 basis point cut, and that's what happened here. Clearly, maybe more emphasis on what's going on in the labor market than on inflation.
Right. This is absolutely a vote for the dual mandate. And so trying to protect maximum employment, things are good right now. They're not pointed in a good direction with the labor market, but that's why you get out ahead of it. So this is a risk management, and it's showing that the Fed is taking the risk on the labor market side very seriously. And that also shows up in the projections, right? They are trying to move. This is not the last cut. So it's a really...
Remember, guys, Tom Lee said that the first week plus after the Fed rate cut, we could actually see markets go down. Tom Lee probably has a better hit rate record than I do as of late, so it'll be very interesting to see if he's right.
Important recognition of what we've been learning about the labor market, and the Fed is reacting.
So, David Kelly, they're opening big, and you think that another, you said that by the end of the year we would be 3/4 of a point lower than we are today. That would imply then that.
I'm going to pause these guys just for 2 seconds, guys. I just want to look. I want to pull up on the screen here real quick and just take a look at other things in my watch list to see how they're performing as a percentage change right now. So Riot up 3.59, MicroStrategy up 3, ArcG up 3, SoFi up 2.52, PayPal up 2.1, Hood up almost 2%, Tesla up 1.75%. I think today is looking pretty decent, guys. The Russell is up 1.6%, outperforming the other indexes. This doesn't look like a bad day to me at all. We'll see if it hangs, but feeling pretty good, guys. Feeling pretty good.
There would be 2 more cuts of 25 basis points, or at least one.
You know, I think we probably will get two at this stage. I mean, I would have preferred they went 25 basis points today. Obviously, it's
500 people. Please hit the like. This is awesome. This is my biggest stream in ages. We could break a record. If you guys could share, like, whatever, chat, get things busy. Awesome. Thank you.
Very close call in futures markets. But the important thing to recognize is that cutting interest rates at the start doesn't stimulate the economy at all. There is a J-curve effect. It actually slows the economy because people begin to anticipate those lower rates, so they want to wait for lower rates. It tells people that the Fed is scared about unemployment. I don't think they...
I would make the argument, though, that's why he front-loaded the rate cut, because it's dropping 50 bips and now we're in the 5s, okay? People are going to refinance if they need to in the 5s. That's why he front-loaded this shit. There was a purpose behind it. Why doesn't this guy know that?
It really should be, but that's...
Should I be wearing a tie and a suit? I don't know.
It's a message it gives, so it undermines confidence. The reason I thought, bringing rates down from a high level is like, bringing a piano down as a flight of stairs. You've got to do it very carefully and very slowly. That would be the right way to do it. And I'm a little worried that they started off in a rush here. But I do think this...
You fucking idiot. He literally contradicts himself here. We need to do it quickly so that people right away go, hey, I should refinance now to avoid the gap he was just talking about. How fucking stupid is this guy?
Economy strong enough to deal with it. I think we will, next year I think we'll get 2% growth, inflation 2%, unemployment close to 4%. So I think it's still a healthy, strong economy.
Does it risk in any way, Jim, reigniting inflation?
No.
Look,
no.
To some degree, it certainly could, but really...
Guys, but my boy Banana Stocks, whatever the fuck his name is, he says it too. Deflation is our biggest concern. It's the 1% on trueflation that they're showing for real inflation right now. It's not inflation. I know that's a popular narrative, but if you don't understand a lot about economics, understand that. It is not inflation that we have to worry about.
Depends on what happens to the labor markets. Look, I see this as a three-dimensional problem for the Fed. Number one, where do they see the neutral policy rate being? Number two, how quickly do they want to get there?
Fast.
And number three, what is the employment situation? Is the employment situation going to deteriorate more quickly? What the Fed is signaling today is that they are very concerned that the unemployment rate could start to accelerate higher.
And they
so
should
to me,
be.
Yes, this could be something that might unanchor inflation. I think it's way premature to say that. I don't think that's what's going to happen. But what it does signal that they are worried that there could be a faster pace of layoffs and job losses and things like that. So I think the markets, while they may be happy that the Fed cut interest rates, they might have to ask the question as why they're going as fast as they're going and what is the cause of that concern. So I think it is a little bit of a double-edged sword here.
Claudia, what about that very interesting point that David made, and that is that perversely, sometimes cutting interest rates can slow down activity as people wait for interest rates to go even lower.
I already explained how that works, guys.
Right. Well, the first thing I'd say is we know from this cycle already that the comparisons back to history are going to be really tricky. We haven't had a kind of easing cycle like what the Fed has started us into in a very long time. So and we've had a lot of what are Fed interest rates even doing?
Thank you for not
and this
saying
is a
anything.
Fed with a 50 basis point said we are going to do this, and we are going to be not necessarily aggressive, but we're really going to move on it. And I think that can show up in market rates and then help with that, behavior changing.
Yes.
David, one aspect where I'm very
right.
curious about how markets and banks react is Americans have actually been making a lot of money on high rates if they have their money in money market funds, if they hold treasuries and so forth. Taking things down a half point doesn't change a lot, but it might just be enough. And I'm curious what your take is to kind of start moving money around and at the margin take a few dollars out of what's been a very lucrative place to park cash.
Well, I don't think it'll have that effect. I mean, I do think that it squeezes the income of older Americans just a bit. But what it does, I think it will introduce the question of, well, how much is the economy slowing? And that is not necessarily good for the equity market, no matter how much it, positively responds to what they've just done today. I mean, as I say, I think the economy is strong enough to handle this. But overall, I think the messaging is very important from here. So in the press conference, it's very important that Jay Powell stress the level of comfort with inflation. Look, we've got lower gasoline prices down 70 cents year over year. We feel good about growth, but honestly, inflation's doing even better than we thought it was, so that's why we can move today. If he stresses progress in inflation rather than worries about unemployment, then he'll do the economy a great service, and I think that'll make this a much safer cut.
Steve.
So if he says nice things, then the market will be happy. Pretty advanced thinking, but I agree.
Claudia made the point, I invite you to pick up on whatever thought or tangent you would like, but Claudia made the point that this is a different circumstance. We haven't had this kind of initiation of a rate cutting cycle in.
I just got 3 people watching me on Rumble, guys. 3 people on Rumble. Hey, whoever you are, please type in the chat. I'm stoked. I just turned on Rumble today. Hello. I guess I've joined the far right, guys, so please say hi.
In a long time, certainly not under these kinds of circumstances. When we've had rate cutting cycles before, it's been in response to economic crises like the pandemic, like the financial crisis in 2007, 2008, 2009. Here, it's a different set of circumstances. Economy's pretty good. Very little sort of idea that a recession is on the horizon. Talk me through that, if you wouldn't mind.
Well, Claudia studied history. That's why she's famous in our world. I've studied history maybe a little bit less, and I can tell you with experience that nothing works, Tyler, in terms of comparing this to any of the cycles. There have had a complete lack of.
All right, I'm going to slow it down for people.
Fundamentally, it seems like what the Fed decided
this is only 1.25,
is this was
bro.
really a transitory supply shock, somewhat exacerbated by somewhat loose monetary policy, somewhat loose deficit spending. But if you hear the Fed talk now, much of the blame ends up being on the supply side shock that kind of worked itself out. A lot of that created a background of why the heck are we so high if it was a supply shock and it's largely worked itself out. We have another half a point, maybe a full point to go, depending upon how you want to measure it. And we can get that done by being restrictive, but we don't have to be this restrictive. What Powell took, I would say, Tyler, is 50 basis points of what could be an easy 100, 150 that the Fed can take and do so while remaining restrictive and not even being in danger of sort of further stimulating the economy. The game now is going to be restraining the market.
All right, bros, I got 5 people watching me on Rumble right now. I'm super excited. If you're on Rumble, please type something in the chat. I just want to see you guys, okay? I just want to see you guys.
And it's forward pricing of where the Fed is going, because that forward pricing, Tyler, as you know, works itself into the real economy through the floating rate mechanism that.
All right, hold up. Somebody just said, what does this do to Bitcoin? What does this do to Bitcoin? I'm going to go back because some of you might be coming in a little late to this, okay? Here's what it does to Bitcoin. We can look at from, hey, thank you for the tip. I don't know how much that is. It looks like a big number. I can't see. There's like a balloon in the way. Oh, thanks, man. $20. That's fucking awesome. Haywood, thank you very much. That's very much appreciated, man. Very kind of you. All right, guys, here's what it does to Bitcoin. When we look at the U.S.-Iran escalation, the COVID outbreak, the 2020 U.S. election challenges, Russia invasion of Ukraine, U.S. regional banking crisis, and the yen carry trade unwinding, well, that one doesn't quite show the 60 days. I don't even know if we've been 60 days. But here's what happens. In some cases, Bitcoin went down. COVID outbreak, Russian invasion of Ukraine, Bitcoin went down, mostly because it went up a lot beforehand. But if you look at that, instead of 10 days, if you look out over 60, Bitcoin outperformed everything. The SPX, gold, it kicked ass. And it was by far the best thing to own. And note that in 2020, the U.S. election challenges, November 3rd of 2020, we are not far from that. We are a month and a half, 6 weeks away from that. After that event, the next 60 days was up 131%. That puts us near the end of this year, beginning of next. That is what's going to happen to Bitcoin. We're going to get fucking rich. So understand that. It's very important that you understand that.
That allows businesses to go out and borrow at tomorrow's yield. And that.
I have 12 viewers on Rumble. 12! Oh, I love this.
That's where the stimulus comes from. So now we begin a game of the Fed on top of the horse, holding the reins and figuring out how much to let out the reins and how much to pull back. Right now, they let it out 50.
It's a great point, Steve, to emphasize, that's where a lot of this will hit the real economy. And in some ways, that move's already been made, and we'll see how markets react. And on that point, Jim Karen, I just wanted to point out, if you told me that they were going to cut 50 and asked me what I thought the stock market reaction would be, I could go either way. The reaction so far has.
We're going to get to
recent
current.
Run of data has been.
We're going to get to current because I don't want to be delayed. So we're going to sit on this, and I'm just going to speed it up to 1.25, which is about what we were doing. But we'll hang out here. But I'm very excited. What's your Rumble name? Micro to macro. How crazy, huh? Basically the same thing. Yeah, guys, hit the like if you haven't. Let's keep rolling here. I was just going to check with chat. Nothing but real talk from Jesse. That's true. Cutting due to foreseen weakness in the economy. Yeah, ignore it, though. Powell isn't going to say that. Haywood Jabloon, that $20, that was sweet. Fuhr from X says hi. Alberto, show us your faces, brother. Anthony Clear, 500 people watching is insane. Disease Kodak, looking for group. Thanks for supporting the community, Haywood. Again, this is all of us, guys. I really appreciate it. In the future, maybe there'll be a way to like share the wealth for advertising. I think that would be really cool. Wouldn't that be cool if you could literally have like disperse amongst your community a percentage of the ad revenue and things that you receive? I don't know. I think that sounds like a fucking awesome idea. Somebody needs to invent that. Thomas says 3,500 people watching on X. Awesome. I've noticed massive increases from X, and my YouTube channel is growing because of it too. Patrick Reddy, who keeps cheating BTC? Tim Wolf, what's your Rumble name? Richard Wallace, that is what's going to happen to Bitcoin. We're going to get fucking rich. Yeah, that's it. Can I say it any plainer, guys? Can I say I'm not a financial advisor? I'm a fucking high school dropout. I happen to be a multimillionaire. I live pretty good. If you read down below, you could see my little disclaimer talking about being a high school dropout and sucking at investing when I originally started it like 20 plus years ago. But I'm really good at it now, at least recently, historically. I made 600% last year. And this data point right here shows you that Bitcoin is going to go up a lot. And I just don't know how to make it any simpler for people, but I really hope you guys are paying attention. I want people to come with the ride. Let's listen to this shit. Oh, let me get the mute off.
To any softness in data over the next 7 weeks until the next Fed meeting, and maybe left the impression the Fed was willing to fall behind, even if it's not behind just yet. All that mixed together, I think, has to be put against the fact that the S&P 500 was already near a record high, already at 21 times.
All right, guys, 13 minutes for Papa Powell. 13 minutes for Papa Powell. Then we'll jump over to the live stream over here. It's not far off right now. We're probably just going to keep listening to commentary from these guys, even though I don't know how valuable it is. I think mine's better, at least in this case. I need to get like some co-hosts on here that kick ass. Some of you guys are going to have to come on. Let me see here. Let me keep rolling down. Needs 55 says stocks pump or diminishing quickly. Hey, Lars, thanks for the gifting the 5 membership. You guys rock, man. Jesse, what's your Rumble exactly? Not coming up. I have no idea, dude, but I got 25 people watching me on Rumble right now. I think it's working. Let me refresh it. It says 25. It says 25 and I see myself. This is so exciting. Let me pull it up again. I'll show you. That's me on Rumble. Rumbling. Advertising a bunch of right-wing shit, probably. That's cool, though. I relate a lot more to those guys nowadays than I do a lot of other people. Don't get me wrong. I'm not that guy. But anyway, yeah, so let's keep going here. I'm just going to play away while I look through chat here.
Forward earnings already pretty much juiced up on soft landing expectations. I don't mean that it's overdone, but it's absolutely based on the premise that we probably are going to keep an expansionary economy and rates are going to be tilting lower at some angle. So all that mixed together, I get the response. Longer term yields up a little more, so therefore a little more steepening of the yield curve. Really,
I need to add more mods. Who wants to be a mod? Tell me if you want to be a mod. If you're here all the time like C-List or somebody, you got it.
Not an aggressive response in what you would consider to be the playbook for the Fed cut, meaning small caps and regional banks and things like that. They kind of rallied into it a little bit more on a week-to-date basis. So maybe we'll see if that's to come as we, as we get through the day.
All right, Mike. Thanks very much. Let's now go to Chicago and Rick Santelli for the reaction in the bond market. Hey, Rick.
All right, X doesn't work for
I'm going to have to start out with the dollar index, Tyler. I'm sorry. Dollar index has some significant technical issues it's going to deal with. Now, you were all talking about it, and granted, the low is around 100.39. But the key here is any kind of a close under 100.5 is going to be a technical violation where we're almost guaranteed to test if we can hold up at 100. And it certainly looks like it's a possibility. 50 basis point cut, of course, is igniting issues with relationships to the dollar index, not only with the yen, but with the euro. Now, if we switch gears and we go to the 2-year, the 2-year was at 353 before the announcement. It's at 357 right now. It's been as low as retesting. That was pretty much the low, right around 353. And if we look at 10s, they were around 359. They're higher, of course. They're at 365.
Let's check some other stuff real quick, guys.
Forgetting the numbers a bit, as you look at interest.
As much as I love Rick, he's like the shit. Let me real quickly here. I just want to look at the dollar. I want to see what we're doing with other stuff here too. Oh, the dollar's continuing that rollover, guys. It's broke under the 200, just like I said it was going to. Don't hate that. Don't hate that today. Let's check out gold. Gold is up 0.9%. That makes sense. Gold should be up. Bitcoin should be up. We know that. That's all right. What about oil? Drop in oil? Oil's up a little bit, 0.13%. Not crazy. Let's check the MOVE index. That's the bond volatility index. That's up just a hair. Nothing crazy. 2 years rolling over, just like we said it was going to. We're going to the 200. You're going to see the 2.9s eventually. That's going to be exciting. The inversion curve is uninverting even quicker. This sets a timer. It's usually like 6 months to 9 months for the potential of a recession, but it can be longer because this was the longest inversion in history. So one would assume with that kind of oscillation that it could actually take longer to have any kind of recession at the same time. Bitcoin is sitting in the bottom right corner over, yeah, here. Good. That way. The Bitcoin's over there. Let's see if people are buying any insurance right now. Anybody getting insurance? No, less insurance on the puts. Puts to calls are falling off a cliff. I love it. JD's trying to replace you, CFET. No, I'm keeping CFET too. He's my boy. He's not going anywhere. Rumble, I got 25 still, guys. I got 25. I'm blowing up on Rumble. I'm the next big guy on Rumble. Very exciting. But yeah, so we've got some market moving stuff. Let's just dial down the lines of some of my favorite stocks. Tesla up 2.4%, getting ready to break out. I can't imagine how much money I'm making right now. Let's maybe pull that up real quick. One sec, I just got to hide a little bit of shit. Let's look at my main account and see how much money I'm making, just so people know I'm real and that I'm not a bullshitter. I mean, some of you guys could tell them too, but, you know, they don't all see it. All right, 1 second here. At least I have that live consolidated chat where people can kind of see other platforms. I don't know if did anybody from Rumble chat yet? Did I get any Rumble chatters? All right, let me scroll down. Oh, I hate scrolling. I really need a new mouse. I need to figure this shit out. All right, I'm just going to move this over. So not a bad day. Probably up 100,000 across all the accounts today. Big mover, Tesla, PayPal actually in first place. Finally getting some movement. Even the 2025s are starting to move. I told you guys that would happen. I don't think I'll make back a lot of my money, but if I make back 50%, that would be cool on the 2025s. And then again, I'll have a much bigger number for overall gains here soon enough. But those Tesla gains, $370,000 plus the $350,000 I already took out in profits, makes for a really good number right now. Probably $500,000 in gains recently off of that. I don't hate it. Kind of love it, honestly. Not going to lie. I love everybody being here. We better get back to it, though. What do we got? We got 7 minutes. Guys, don't bail from the stream. We got 7 minutes, okay? I'm just looking at my shit. Give me a second. But, yeah, so things are looking good. Still waiting on Papa Powell to get out there. But we got our 50 bips, in case you guys don't know. The market's going up. It's loving it. If we look here, let's actually go to this. If we look and refresh over here, just in my portfolio list, let's see how we're doing for performance. If we sort by percentages, so MicroStrategy, again, still sitting good. ARKG up 2.36%, SoFi up 2.28%, Tesla up about 2%. We've seen a little bit of a retracement from where we were in some of the hype earlier. Could we go down to the short term? We totally could. But as I've shown you already with Bitcoin, it's going to outperform. It's the biggest thing I have, really, if you look at the multipliers from everything that I own right now for crypto stuff and Bitcoin miners and everything else. It's a great investment, and it's going to make us tons of money in the future. And I'm very excited for everybody that's going to participate in this. Again, this is the Bitcoin chart showing you after every major event how much money you're going to make off of Bitcoin 60 days later. It's a lot, guys, including the election. The election was the best time. And if this election doesn't seem like an event to you, I don't know what you're smoking, because it's very much an event. It's very much a big deal. All right, let me look over here. I'm just going to go through chat while we let this thing run. We'll let these guys gab. Actually, let's listen to Rick.
Rates, a couple of things should jump out at you. Right now, about half the curve is above where it was yesterday on the close, meaning 7-year, 10-year, 20-year, 30 years or higher, but it's starting to creep down the curve. The equities have given up some of the ground, and the interest rate complex, first initial reaction was a rally pushing yields down. Then they bounced back. Now they're coming back down. It's going to be a big two-way trade, probably till Q&A. But what you really want to pay attention to is the yield curve. Right now, it's steepened about 5 basis points, meaning long-term Treasury rates are a little more stubborn in terms of coming to the game and rallying, pushing yields down. And ultimately, if you listen to our panel, pretty much every guest we had on today, you know the good side of what the Fed did. But the other side you're going to hear a whole lot more about in the next 15 hours. A, 50 basis point cut this close to an election. B, 4.2%. There used to be a time when that was considered full employment. And
he's going to go off.
The averages on
Rick's
job
going
growth,
off.
they're still on most metrics above 100,000. So with equities making new highs, this is a unique Fed situation, and some Fed watchers are going to be scratching their head. Back to you.
Oh, wow, that was
yield
super
curve has
calm.
de-inverted.
Love you, Rick.
Yes. Yes. Right now you're at 9.6. Your lower yields on the 2s, your higher yields on the 10s.
All right, Rick Santelli, thanks
Ain't
very
wrong.
much. Appreciate it.
And markets are reacting across the board to the Fed's kind of surprise decision. Look, going into 2 p.m., it was almost a 50-50 call. We had really receded the possibility that this could happen. The Fed delivered 50. There was only one dissent. Stocks initially went to record highs. Then the Dow pulled back by 400 points, in fact, within minutes, and now it's climbing again. We'll get more on the market reaction as we build up to the chair's press conference at 2:30 Eastern Time. We'll take you there, of course, as soon as it begins. And Power Lunch will be right back.
All right. 1 sec here. I got to kill the music. All right, I love my friends here. Silas, you're great. What does Silas say? Very eventful day, but it's all on the internet. Maybe none of it is real. I love you guys. This is why I love you guys. Fucking comments like that. That's why you're going to be an admin, brother. Rumble chat is not showing on your screen. Okay. Maybe not Rumble chat. I do see Rumble right now. Crypto Frog says, Udaman. Joanne Maga says, tell them it'll end with 0 and not, well, I can't quite read. I gotta increase. I gotta figure out how to read my chat really clearly on Rumble. You're right, though. It's not appearing in here, right? I'll have to figure that out. That might be a weird thing with Restream. It is a custom RTMP, I want to say, what it is as far as the streaming technology. It's all weird, guys. It's like there's a big learning curve on a lot of this stuff. And I can stream evidently straight from Rumble, but I really don't want to do that since this is my primary platform on YouTube, at least for now, until I can hopefully be more on X. I don't know. I'm hoping X has the best tools in the future. I really love Elon, and I think he's probably the best for every reason. All right, let me get caught up with other stuff. So Nikki says, net flow showing this is tops for now, at least until Powell. Yeah, that's fine. That's normal. It's all about Powell. And if he says if he lets the doves free, then we're gonna be enjoying life. It's gonna be very Purple Rain type stuff. What is it? The dove? Yeah. Anyway, my brain's just wandering. All right, let's keep going. Master the game. You and Andrew Tate will be smoking cigars in no time. I'm not really if you're talking about me, I'm not really a cigar smoker. I don't like smoking some things, not cigars. Mike Lauk, I have known CFET for 45-ish years. He isn't lying. Yeah. That's why I use emojis. I didn't know you guys knew each other. That's cool. All right, Anthony Clear, over 300 likes. That's dope. Thank you, guys. Michael Krause, my good buddy, still searching for you on Rumble. That's okay. It'll get bigger over time. I've only got 21 right now, guys, on Rumble. We're barely rumbling on Rumble. That's okay, though. C-List, very eventful day, but it's all on the internet. Oh, yeah, that was funny. Chris Federal, Rick and Joe are the best on CNBC. They are by far my two favorite people. And you know what I love about Joe? I love both of these guys because they love this country, which makes me love them even more. And they're just genuinely good people. And you might not necessarily agree with their beliefs. I do, but they're really good people, and you can tell. RJ Cohen found you on Rumble. Sweet. John Frank, lol. RJ Cohen, note, 0 at the end and not 0. I'm not sure what that means, though, in regard to the comment, but Jax, how big of a retracement is there going to be? Definitely feel on what Papa Powell is going to say next. I actually think we could go up. I think the consensus between Tom Lee and a lot of other people is that, we were going to get 25 bips because the poll here said that like 60% of you almost thought that. And so we did more than you thought we were going to do. And I think the second part is Tom Lee thinks that we're going to be down for the next 10 days because that's what historically happens in the month of September. But I don't know if that's true. I think, again, when everything lines up and paints a picture that it's going to go one way, markets usually like to do the opposite of what everybody's going to think. It's just weird short-term market perception stuff is strange. I could be wrong on it, but I don't care either way. This is bullish for markets. Dropping 50 bips gets it to where some people will start refinancing debts now and or buying that car that they wanted to get because rates just dropped by 0.5%, and now maybe they can get this thing a lot cheaper. And it makes it to where companies like Tesla are going to do really good because a 50 bip cut makes it to where a Tesla is a lot fucking cheaper than it was before, and people don't want that other stuff. They want Teslas. Danny 24 up. Yeah, probably, man. Why not? Here we go. Oh, is it happening? Are we getting ready? Let's get to the right screen, guys. Let's go over here. All right, I'm going to turn off the other screen. I'll leave it on, actually, for commentary. But we're waiting on Papa Powell right now. Let me make sure audio is on. All right, we should be good. We're just waiting for him to come out and to start speaking. So this should be fun. You said it's on? Is it on? Let me refresh. Maybe he's already started. Sometimes that happens. Is this it, though? You guys, I don't see him live. This is literally CNBC waiting for him. So I'm having to imagine he's not on yet. Last zero is, oh, yeah. Oh, yeah, micro to macro. Totally. Now I see what the problem was. Thanks, Needs. Hey, Needs, do you want to be an admin? I feel like you'd be great. Not yes. Quiet, not quiet on. Sure. All right, awesome. I'll make you one if you want to do it. All right, so we're still waiting here, but that's great. We got 541 people watching right now. Thank you guys for everybody that is here. I'm going to go ahead and update this number so that it shows. I was really hoping that it would be possible for me to... Oh, never mind. Hit the like if you would, guys.
Good afternoon.
I'm going to turn him up.
My colleagues and I remain squarely focused on achieving our dual mandate goal.
One sec.
Of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years.
One more second.
The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated
1 sec.
As of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool.
About to break 61K on Bitcoin.
Averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly.
Please hit the like if you guys would. It's very much appreciated. We're at almost 600 people. Thank you. I won't say it again.
The labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Q&A time.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you weren't thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50, and how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had.
This is where Powell shines. So he said, hey, we were aggressive at this. He said all this little diatribe. And now he's using a sense of humor to lighten the mood and let people know everything's going to be okay. This is where he does his business.
A lot of data come in. We've had the 2 employment reports, July and August. We've also had 2 inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. So we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members rather of the committee are thinking today, assuming that their particular forecasts are realized.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher than long? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%. Inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment, moving to a more sustainable level. So the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral, and we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year? For example?
We're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina. Hi, Chair Powell. Gina Smilik with the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Sorry, Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay.
Great question.
Multiple questions in there. So I would say we don't think we're behind. We do not think we think this is timely. But I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, "Oh, this is the new pace." You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking but also be cutting rates.
I'm going to comment on that later. Very great.
Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it?
Haitian migrants.
Clearly, payroll job creation has moved down over the last few months, and this bears watching. Meant by many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018-17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, the retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from companies that that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some law on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now.
Sol is more than 50% of my bags, yes, for shitcoins.
And we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael McKee with Bloomberg TV and Radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if, as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%. over time. So, and policy we think is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be their wage increases, rather, are still just a bit above where they would be over the very longer term to be consistent.
What she's saying is good.
With 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about it.
All right, real quickly, to answer John Frank's question, what do I think will happen to the labor market? You got to remember we've imported hundreds of thousands of illegal immigrants through this Biden executive order. That's kind of why we have this Haitian crisis in a number of cities, including Springfield. So, but these are actually helping with employment numbers and productivity numbers and GDP numbers. So there's some short-term benefit there too. Whether it's good for us over the long term is totally different.
About that. Vacancies over, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person as measured. It's now below around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, I could go on and on. There are many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change particularly over the last few months. And, so what we say is as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And, that's right. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
Expect to learn between now and November that will help inform the scale?
Real quick, they've got dry powder. And he said that if they have to go faster, they're going to do it. So he's trying to ride the line, and I think he can actually make it happen because, again, he's doing what I said. He's flipping on a fucking dime. Just like inflation was transitory and then it wasn't, we're doing the exact same thing, but we're trying to whip it in the other direction as fast as we fucking can. So I do think he's going to try and keep up with that.
Scale of the cut at the next meeting?
More data, the usual. Don't look for anything else.
More data.
We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. On the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as...
I want to hear that, but guys, I'm kind of excited. If I look over here real quickly here, it looks like the portfolio is well over 100,000 today. Just the main is almost 100,000, so we're probably doing 125, 130, including shit coins. Also, I will show my altcoin portfolio in the market recap at 3 p.m. today. So stick around for that if you want to be able to, talk about this further. Now that we know things are looking good, we need to talk about next steps. And with all this stuff happening, with the government shutting down in 10 days, with the election coming in 6 weeks, and just with the remainder of this year going into next. So stick around for the market recap. I'll start that up at 3 after this ends.
Worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I think we are. It's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Chair Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5%, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate.
To be clear, the market is down across the board since this news came out over the last hour here. It's actually showing a little bit down. Let me look at it on the daily, too. So again, it's retraced a lot of gains across the market, but some areas are still holding on versus the other. But we could see short-term downward moves. We totally could.
Now, some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question. You mean after we get through all of this? It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But honestly, we're going to find out. But it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. We only know it by its works.
And one more. How do you respond to the criticism that
he has to say that we can't have negative rates? That would be fucking horrible. If we're back to that after what's happened, that would be really bad. So he can't say that.
Will likely come that a deeper rate cut now before the election has some political motivations.
Yeah. So this is my fourth presidential election at the Fed, and it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve, and we do that, and we make a decision as a group, and then we announce it, and that's always what it is. It's never about anything else. Nothing else is discussed, and I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind. And, it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Jolene. Thank you, Chair Powell. I'm Jolene Kent with CBS News. My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do.
Hey guys, just to be clear, when you invite in millions of illegal immigrants and then like almost 1 million that are legal because of executive order and loopholes that are probably unconstitutional, or at the very least, negating the authority of Congress, you're going to have still inflated housing prices. But we're lowering rates, and those lowered rates are going to make it to where the housing market can open up for existing home sales. It should provide relief.
Which is to be moving up at relatively low levels. But they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this. But, the direction of travel is clear. And as long as market rents remain,
And also the level of inflation that we had, just the high rates, or I shouldn't say the level of inflation, the high rates that we had out there were freezing up all of this stuff and keeping it from moving, which kept prices high. So with insurance going up and all this other stuff, taxes going up, you're going to have a lag.
Relatively low inflation over time that will show up. Just the time it's taking now, several years rather than just 1 or 2 cycles of annual lease renewals. So I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that.
Yeah, I agree with him too. And just to answer a question, Guillermo says, I don't think it's about the 50-bit cut, but mostly what he is saying. They want to see more data in order to react with more. I mean, he says more data all the time. That's literally his message about everything. Markets are forecasting unemployment to go up, though. It doesn't matter if they go up. You're reigniting the housing market. We'll look at some images in a little bit here. There is so much growth that will come from that alone, let alone all this other lending. We're a debt-based economy. Lowering rates quickly was the right decision. He doesn't have to run off the balance sheet. It gives him ammo for next time.
That ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more.
That's fucking stupid.
What's the likelihood of that, and how?
You keep shipping more immigrants, the prices are going to go up. If you actually open up the market and let existing home sales, which normally make up over 80% of the market, let those happen again because people are actually able to buy a new house and not pay 7-8% interest rates, that you're going to have prices go down. You're going to have more liquidity in the market.
How would you react to that?
Fucking stupid question.
The housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down.
Hey, Dougie, shut the fuck up. This is my channel. Don't talk to me that way or I'm going to boot your ass out of here. Okay? Cool. Thank you.
People will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not, obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And, where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And, I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria. Hi, Victoria Guida with Politico. Just following up on some of the labor market talk earlier, monetary policy operates with long and variable lags, and I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, I mean, business people who are actually out there doing business. So I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not that doesn't really answer the question that we ask ourselves, which is let's look. When at this meeting we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? We knew it's clear that we clearly, literally, everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Beautiful.
Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households?
Well, what I can say to the public is that we had a burst of inflation. Many other countries around the world had a similar burst of inflation, and when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. We just keep it low, keep it stable.
Powell's doing good.
We're restoring that. So what we're going through now really it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on, and I think we've made real progress. We don't tell people how to think about the economy, of course, and of course people are experiencing high prices as opposed to high inflation, and we understand that's painful.
Hi, Chair Powell. Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. The Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? After the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be the unemployment rate is very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting. We'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Yeah, pretty much.
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators...
You know what? Hold the second question.
Okay, sure.
We'll give you the second question. So the answer to your question is that yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is that's happening with my support. That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment. And then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
And then yesterday, there were merger reform finalizations from the other bank regulators. What does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Jennifer for the last question. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage. So very hot labor market, and we had inflation way above target. So that said to us, concentrate on inflation, and we did for a while, and we kept at that. The stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today I think we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
Yep, it does.
Vulnerable to a shock now that could tip it into recession.
I don't think so. I don't. As I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a downturn is elevated.
Love it.
Okay, I don't see that. You see growth at a solid rate. You see inflation coming down. And you see a labor market that's still at very solid levels. So I don't really see that. No. Thank you.
That was great, guys. All right, I don't know what you guys throw in the chat, kind of what you thought or what you might summarize this to be like. Personally, I thought it was wonderful. I thought Powell did exactly what I thought he was going to do. He did the 50 bips. That was going to happen. He said nothing but good things about how the economy is doing, how jobs are doing, and indicated that not only, again, the 50 bips is great because he doesn't have to run down the balance sheet right now. The Treasury can still do short-dated Treasury issuance, can still juice the markets really good and make sure that there's tons of liquidity for dollars out there. So that's not a problem. He can say that he's still running off the balance sheet. Even they can start slowing it in the next meeting. All of that stuff is good. But everything, this was as good as I could have expected it to be. Now, what will happen with the price of things? Will they skyrocket soon? I think the market should go up. But again, if Tom Lee's right and if history is right, we know the second half of September can suck. And then after that, markets take off. Will that be what happens right now? Possible. It's possible. But it doesn't flippin' matter. We know what Bitcoin is doing next because we can look at the history here of the last election, the U.S.-Iran escalation, the COVID outbreak, the Russian invasion of Ukraine, the U.S. regional banking crisis, and now more recently here, hopefully, and by the time the Japanese yen carry trade plays out, we'll see Bitcoin outperforming the S&P and gold yet again for, what, the sixth fucking time. Out of all the major things that have happened since January of 2020. So this is what's coming. We are going up. Don't fret about it, guys. Don't expect a bunch of bad things to happen. I think that is definitely the wrong play here. Now, could markets come back down? Yes, that can always happen. It can always happen. You got to be ready for that. And if it happens, you know what I'm going to do? I'm going to look at those MicroStrategy options that we were talking about the other day. I would be excited to actually see the market come down and be able to purchase those and get a lever towards the upside if it does in fact happen. Let me see. Can I even get the latest Fed projection? I guess they've just got it wiped out for now. It says next Fed meeting, 49 days, 22 hours. Oh, here we go. So a 25 bip cut. I think that's what we would be at. Or is this any cut at all? It's hard to know. What is our going rate right now? I'm trying to remember off the top of my head. Current rate, 525 to 550. So next Fed meeting in 59 days says that we're getting a 25 bip cut. Potentially 50 with 3% of it. So I think we're in a really good place here, guys. I'm very excited about what happened. I think it's perfect. I think it's exactly what we need to see. And I think people are being too overly negative. Don't get me wrong. There's some crazy shit. The government's going to close down in the next 10 days. That's weird. We've got the election in 6. It looks like, I mean, hey, if there's a third assassination attempt against Trump, would that be odd? This is a crazy time that we're in. All kinds of things have happened, but just know the monetary system is expanding, and as it does that, we're going to make a bunch of money. And again, I'll just show you something else under Bitcoin here real quick. I'll just go back a few. I want to show a post that a friend of mine did. If you guys don't follow him, I tell you to all the time. His name's Cantonese Cat. Please follow this guy. He's wonderful. He had over 20,000 followers. He lost a bunch. He needs to get some back. But if you look here, it shows global liquidity from 2018 to 2020. And it shows how once we broke above it, Bitcoin's price exploded. This is the same kind of thing that happens with the election cycle, too, when the money printer goes burr and everybody talks about printing money. We're so heavily indebted right now, guys, that we can't help but print money. That's the thing people need to understand. There is no other method but print. And we're getting ready to do that right now. If you look on the right-hand side, and you can tell what's coming next. It's almost a mirror image. The only difference is I would say that we're more bullish this time because before we had that high peak, we had the mid-cycle pump, but we never got above the previous peak. This time we've been grinding, but we've been grinding above the previous peak, the one that was neutered by the Fed, raising rates at the most aggressive rate in history. And so, if anything, we've got more spring to the upside. And just by Cantonese's projections, it's 173,000 to the top. Mine are a little bit more optimistic than that. You guys know me. And let me actually pull mine up here real quick for what I believe is happening with Bitcoin. Because I do think it's important to talk about. I think Bitcoin is the barometer, guys. This is the thing that's going to go up the most in the time ahead. It's going to be this. And let me see. No, I wanted to do BLX maybe. Is that what it is? I need to pull up my long-term chart. For people that haven't seen this very much, take a look here, okay? So I've got to, let me clean this up a little bit. I've got to change the time frame. It's got a bunch of words on it. Let me expand it. So again, this is multiple cycles that we're looking at here. And I'll just maybe do this. Let me see. Can I get rid of just the dates? Let me see here if I can get rid of the dates. Drawings. That doesn't help. Let me see. Indicators. That doesn't really help so much. I made a little bit of clutter out of it, but not a lot. Anyway, so you can see here previous cycles. Didn't mean to move that. If we go back over previous cycles from the first, with the first halving, the second halving, the third halving, the fourth halving that just happened now, you can see what the pattern is after the halving. It's going up. It's going up. It's going up every single time. And the reason it can do that is the inflation rate gets cut in half. The monetary system is the best in the world out of any money, just like BlackRock is telling their customers right now. It's the best form of money on the planet. And we're seeing right now a consolidation that is getting ready to rip higher in Bitcoin's price. And my projections are quite a bit higher. Let me actually just go back to the regular Bitcoin one to show you that. Plus, it's not showing just because of the size of it on here. It's not showing as nicely as I would like it to. Let me go back here real quick. I'll save that. And then let me go over and get the Bitcoins here. Because I thought that chart had it, but it doesn't. It's got like a little representation of it, but not enough. So let me just do this here. So I'm going to go ahead, shrink this up, and then we'll pull this over. Let me pull this down. All right, so my projections are quite a bit higher, and I need to change some things here. This is what I'm looking at for the cycle, guys. It's high. And if you look here, there is definitely symmetry to this. I'll just switch it out to the monthly so you can see it. If you look over here, there again, there's the last halving, there's the next one. If you look over here, this is a perfect channel that we're operating in. And since I believe the last one was actually neutered and we would have got to 100,000, technically this red bar here could be a little bit higher than it is, but it's real close. It's a beautiful looking channel. My high targets, I'm going to start selling. I'm going to get out of all my multipliers by 150. That's right over here. That's at the .786 fib. But I think that the price can go to 249 to 275,000, right around there. And that's what I'm planning on. Those are my top markers. So anything I'm left owning in Bitcoin after the 150, I'm definitely getting out at 255 or 280, depending upon the timing, because again, this thing is curving higher. But that's what I'm looking at for targets. All the multipliers out by 150. And then at these higher levels, getting out of my Bitcoin related investments outside of my hardware wallet stack that I keep no matter what. So this is what I'm looking at for returns, guys, and these aren't small. So just getting to 92 is 50%, and with the things that I have, I mean, I can get 4 to 5x off of that easy. And then at the same time, the 150 level is 150%, and I think I can get up to 10x on some of my investments off of that. And this is the best asset to own right now with what's going on with the economy and what the Fed is doing right now to lower rates. Again, the housing market's going to expand, guys. That's going to be looking beautiful. You got to realize rates are coming down hard. If we look here real quick, I don't know why this shouldn't be showing Great Britain, I don't think. Let me just clear all of it and then get the US only. All right. It's still showing Great Britain. What the fuck is going on here? Why is this thing not refreshing? Okay, there we go. So we finally got something here. So, but if we go back, let's see, what did I want to look at? Housing, let me see. I'm trying to remember the name of the, let's see, housing, maybe. It might be real estate. Existing. Let me just see here. Existing home sales. Let me see if this is what I'm looking for. This is one. So look at existing home sales. Look how frozen this is compared to where we were all of 2005, all the way down here. We're just not seeing the same level that we were seeing that was in a ramping schedule over here in the 6,000 range. And we're going to start seeing more of that soon. It's not exactly the chart I'm looking for, though. Let me see. Home. United States home sales year over year. Pending home sales. No, just home. Let me see what home. See if this is any better. So yeah, this does a better job of just showing how neutered the market is and how it's down near the lows of what it was in the 70s and about the midline mark of the 80s and then really before the 90s when the housing started to explode. And then you got to remember, since 2008, we've had a vast undersupply because of this whip underneath of here that happened. And we're finally starting to get back to levels that means something. And so home for refinance, and this isn't even the best chart. I'm trying to find the right one. I can't think of what it is. But this isn't even the best chart. But the housing market is going to literally explode here soon. Well, metaphorically. Let me see if I can find any more. I'm trying to think. Real estate. No. Oh, real estate maybe. Let me see. Maybe that's what I'm looking for. No, that's not it either. Why the heck can I not find what I'm looking for? Let me go back here. We'll go back this month. I'm sure I can find it in here somewhere. Wasn't that long ago. I just can't remember the name off the top of my head. There's ISM. Let's see. Actuals. Retail sales, industrial, exports, PPI, inflation, average hourly earnings, jobless claims. Does anybody see anything real estate or housing in here? Throw it in the chat if you guys know what I'm looking for. Because these are good examples, and I want to try and find them. Maybe the NHAB housing market index. Maybe that's a good representation. Let me see. I mean, it shows it's depressed, but it's not the one I'm looking for. Dang it, all to heck. Oh, housing starts. Probably still not the one, but building permits might be okay. Again, you could just see depressed levels. That's the gist of it. I can't find the one I'm looking for. It doesn't matter. But again, guys, I don't think I'm probably gonna hang up here soon. But I think this is good for markets. Let's look real quickly. Let me drag this up. We'll just take the Tesla's up 1.5%. Bitcoin's still up. Let's look at the heat map. The heat map looks like it's recovering, guys. We had Nvidia down a decent amount. Again, Tesla was barely up. Now it's up 1.63. Apple coming up. So I think we're gonna see a bounce in market. Let me just look at my portfolio over here. And later, if you guys come to the market recap, we'll look at my crypto portfolio. We'll talk about this in more depth. That'll be happening at 3 o'clock here. But yeah, PayPal up 2.5%. I love that. Hood up 2%. MicroStrategy up 1.7%. Tesla up 1.3%. SoFi up 1.117 at 822. These are all good numbers, guys. These are all good numbers. We'll go over them more a little bit later. Thank you guys very much for coming to this and just the sheer amount of people that are here. This was awesome. Hey, real quick, before I go, let me just see. I want to see what we're saying here. All right, I do want to hear this. I want to hear this, actually. I'm going to go back. I like listening to people that have interesting things to say. So we might just jump back a few seconds here and see what we get. All right, here we go. I want to listen to this 1 second here before I go.
Volatile. Following the decision, we can take a look. Now we are higher across the board. We'll track it, of course, over this final stretch. Welcome, everybody, to Closing Bell. I'm Scott Wapner. We're live today in downtown Los Angeles at Double Line, and we are joined now by the firm's founder, CEO, and CIO, Jeffrey Gundlach, who always joins us on Fed Day. Thanks for having us here once again.
Nice to be here.
You said yesterday when we spoke 50 was your call. That's what you thought it was going to be. Now we have that. Now what's your reaction today?
Obviously, I'm not surprised because I thought it was going to be 50. I thought it was interesting that later in the press conference, Jay Powell admitted that they maybe could have gone in July. I remember when we met 6 weeks or 7 weeks ago at the July 31st meeting, I said I think they should have cut. And what probably spurred my confidence that this cut was coming was since July 31st, the 2-year Treasury yield has dropped by more than 50 basis points. It's changing. There's a lot of volatility in rates today, too, after this Fed meeting.
What do you make of that? Why are rates up today, do you think?
Well, the short end is down. Well, it depends what minute you look at it. I'm taking a quick look. I guess it is up a little bit in yield. It did initially rally.
Yeah, like two. I mean, I can look at it now as we have this conversation. 2s, 3s, 5, 7, 10, 30. Yeah. They're all those yields are up. Why?
All right, after this, we'll check out the Kamala Latina mode. We will check that out.
They're all up. Well, I think that the bond market at the long end is in particular where the yields are up. And the long end of the bond market doesn't want the Fed to be easing aggressively because they're worried about inflation. The rates have come down a lot this year on the short end, not very much on the long end. And that the Fed easing strikes the long end of the market as being inflationary. And so they're building in a premium against that. I think the word of the day was recalibration. He said it a lot of times that, they're...
All right, I do want to hear the rest of what Jeffrey Gundlach has to say. He's awesome. He works at Double Line Capital. A very insightful dude. I do want to hear what he has to say. But here's one of the things I'm loving right now. TLT is down 1.15%. That is a great thing to have happening right now. I want to use this play in the future as cash when I start making too much money off of my other plays. If the long end of the curve is pushed down for a while I'm making a bunch of money in other stuff, that is like the most ideal scenario ever.
Recalibrating the rates. I think he seemed to relax to me. He even cracked a couple of jokes, which you don't see much from Mr. Powell. I think he felt good that he was now more in sync with the bond market. The bond market is very flat in yields from 2 years out to 5 years, even 10 years. It's right about 350, which to me suggests that the base case is that the terminal rate for the Fed funds rate, given current circumstances, is 350. And interestingly, they sort of said at the end of 2025, they think they'll be at about 350. And so he's now very much in sync with the bond market. And I think he was uncomfortably out of sync with what was going on, particularly with the 2-year Treasury, which I always say the Fed follows the 2-year Treasury, and they really had to do 50 to get more in line with that pricing.
You've made the argument, and you did again with me yesterday, that the Fed's behind the curve. The chair himself was pretty emphatic that he says we're not. Your reaction?
Well, now they're not so far behind the curve. I think they're
And of course the Fed's going to say they're not. If he said we're behind the curve, do you know what would fucking happen? Do you know what would happen if he said that we were behind the curve? The market would collapse. He can't ever fucking say that. Jason says, you the man. Gavin24 says, meet Kevin open call options on TLT today. Oh, good for him. That makes sense. So those should play out really well for him. Let's see, how are his call options doing? Down 1%. Yeah, he's going to make a lot of money off of those. I wish he would stop being such a short-term investor. That seems to be a problem of Meet Kevin's.
A little bit, because they're still up at 4 7/8 on the middle of the Fed funds rate, and bond market's down at 350. But it seems to me that they're very open to keeping this process going. It's interesting that the next Fed meeting is after the election. Usually it would be before the election. I think they punted it a week. So they'll have a lot more potential to cut 50 in November than they would have if it was right before the election. Then it starts to, I don't really put much credence in this idea that the Fed is thinking about elections. Jay has said that repeatedly.
I don't think that is the driving force behind Jerome Powell. Jerome Powell cares more about his own legacy and not having the financial system of the United States government disappear and devolve and have the world reserve status just erode under his leadership. He wants a soft landing.
I actually take him at his word, but I still think it would be rough if you did it 2 days before the election and had a 100 basis point cut.
The Fed is, I think it's fair to say, never really been in what you might call the insurance business, right? They're data dependent. They react when the data suggests that they should react. Was today a bit of an insurance policy?
Yes.
By doing that? Because he noted multiple times the economy's basically fine.
Yeah, the Fed isn't known for insurance, but man, they are insurance now. And again, everything that we've been doing in the federal government, whether it's the Treasury or the Fed, has been accommodative to save the markets, to keep them from fucking falling. Even if you look at the Silicon Valley Bank disasters and the crypto banks and all the stuff that was deteriorating a year and a half ago, it's all done to say, hey, don't worry, guys. Deposits, they're not FDIC insured for $250,000 anymore. It's fucking everything. The federal government has you. Everything they're doing is insurance. We have a 130% debt to GDP. We can't help but be insurance for everything. Otherwise, the economic, the entire economies of the world will devolve. We can't have it. So they have to. They're insurance. That's all they are anymore.
He said the economy's solid. He went on and on about that, and multiple times.
He used the words risk management more than once, and that strongly suggests an insurance policy type of mentality, at least partially, because he knows that the employment rate, the jobs, they're reported the first Friday of the month. He admitted that they're artificial. He actually said that today, that there's something artificial about them because they keep revising them lower. There was that monstrous 818,000 jobs on the revision, and it seems to be happening consistently. And he said, we'll make a mental correction now on the first Friday of the month they come out, which would mean about, just think of it as being 75,000 jobs overstated. And so I think if we get to an employment report that's at 100,000 jobs, that's going to be a real danger signal, because if you clip 75,000 off of that, you're getting down, you're starting to, fly the plane near the tops of the trees. And also, I want to point out, as I always do, that the household survey, which is also an important survey, tends to be more accurate at turning points in the economy. That has had negative full-time job growth this year, all through January. Now we're 8 months, negative job growth, and the part-time jobs are almost zero. So the surveys do not really jibe with what.
And all the people getting jobs are Haitians and illegal immigrants, because U.S. citizens lost like 870,000 this last year, while immigrants and illegal aliens got over 1.2 million.
But they're clearly weakening, and he acknowledged that today.
But do you think the economy is weaker than the Fed chair himself just said?
Yes.
I think the present data supports, and it's backward-looking, but the present data, which is backward-looking, supports his statement that the economy isn't showing signs of significant stress. And GDP now, and the most recent quarters of GDP, they're showing up at about 2% real, which is pretty solid growth. I mean, it's the growth that the CBO uses to make their predictions into the future. But I do think that the interest rate problem with credit cards in the economy is significant. I think the level of debt on the consumer is very high. And so I expect to see weaker economic data in the coming reports. I still think there's a good shot that the history books will say September of 24 was the start of a recession.
Steve Leisman's come out of the room. I want to bring in our senior economics reporter.
I actually disagree, but we'll see.
Steve, how close of a call was this really? The Fed chair used the words broad support for a move today. And of course, we did have the one dissent, notably by a Fed governor, which we haven't gotten since 2005, at least somebody of that stature.
Yeah, my old good friend Mark Olson, who dissented in favor of an easing of policy, which is what Fed governors typically did. We haven't had one dissent in favor of tighter policy in a while here. Scott, I want to bring your attention to the word recalibration and maybe a discussion about what that means here. The chair used the phrase about 5 or 6 times in the press conference. It was part of his opening remarks. And I asked him the question, how can we know, given that the data has been reasonably strong, actually running near 3% on the GDP tracking forecast for this quarter? Retail sales were strong. Industrial production was strong. So I asked him, how can we know what you're going to do? And listen to what he said, and I'll give you my thoughts on this on the back end of it.
You'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time.
So what you're doing here, Scott, is if you're recalibrating policy, you're almost in a way disconnected from what the current data is telling you. And it means you're going to go down, and you might go down in what Jeff is talking about, 50 basis point increments. If the inflation data is a little higher, if the jobs are a little higher, you're recalibrating to get to a place where you can respond to the data. But if you're way high, which is what the chair is suggesting here, you can't respond to the data adequately if you're way off the marks. You got to recalibrate and bring it back. And I think that's where the Fed is going. And that's why I think I agree with what Jeff is saying. I disagree on the issue. I think he took a little bit more, I don't know what to say, it took a little more signal from that job revision that perhaps was warranted.
Yeah, I'm just going to say this. So I think the 50 bips was the right move. I think leaving the ability for you to be able to say, hey, we're not going to be tightening the balance sheet anymore too, is wiggle room for the next one. 59 days from now, we're probably going to get at least a 25 bip cut. Maybe that ends up turning into a 50. As those rates come down hard, if he front loads a lot of this and says, hey, we're doing it early, I do think that that's going to help markets expand and explode higher over the short term. There's just too much money printing. The election cycle we have the history of. Bitcoin we have the history of. We know M2 is expanding. We know that Feds and central bankers around the world are expanding the money supply right now, especially in Europe. China, not so much, but they're getting there. They just need a little less pain in their currency, but they're gonna keep expanding the money supply too. They have no other choice. They cannot not print tons of money because their economy is in really bad shape. So I think the markets are going up. It doesn't have to happen today. I would never look at short-term knee-jerk reactions. Again, Tom Lee said we could have a week of down. I don't see why that's not possible. The government shutting down in 10 days, and then in 6 weeks, we're gonna have the presidential election, and it's gonna be a pivotal one that might determine the future of America in a major way, like in regard to capitalism, in regard to free speech alone. These are big deals, and billionaires are probably thinking about all of this, trying to determine whether or not they're going to be able to live in this country again in the future, depending upon who wins and how much power they gain. So there's a lot of uncertainty right now, but I think 6 weeks from now, things are going to be looking better, if nothing else, by the end of the year. And I think that we could start seeing good stuff now. Again, Bitcoin is up 60,338. And if we just look at general markets here, they're kind of choppy for the day. They haven't went much of anywhere. But when I'm looking at some of the things here, like PayPal up 1.7%, who would have guessed that? That looks beautiful. Hood up 1.55. MicroStrategy up 1. Riot up. Meta up. Tesla up 0.5. These things are still doing well, and I don't think this is any sign of a top. People who could people get flushed out? Hell yeah, they always can. That happens all the time. But anyway, I'm going to take a quick break. I got 12 minutes until I start the market recap. I need to get coffee. Okay, we can talk about more stuff there. We'll roll through things pretty quickly since we've done a lot already, and I'll probably get to charts really quick outside of any other questions that you guys might have. But I'm going to go ahead and kill it here. I'm not going to do all the music or anything because I'm short on time. So I'll see you guys, some of you, and at 3 o'clock here. Bye. Peace, guys.